Hello, I'm Peter Herbert. Welcome to the latest in our series of short CPD webinars looking at topical accounting and auditing issues. And today's session is going to focus on 4 key issues for 2021 Academy audits. Here's the programme. We're going to begin with an overview of the reporting season for academies in 21, and then look at those 4 issues, which are in turn income recognition, computer equipment, pension scheme liabilities, and finally, review and oversight of audit work. Let's start off with that overview. And yeah, what I wanted to really emphasize here was that the reporting timetable for this year, which is the 31st of August 21 year ends, reverts to what it normally is. Those that do audits in this sector will know that we had 1 month extra to get everything done in the early part of 21. Or off the back of the pandemic. The expectation for this year is that will all change and go back to normal. So the 31st of August year-end accounts need to be audited by 31 December. Audited accounts then need to be submitted with the audit findings report. And don't forget as well, the internal scrutiny report need to be submitted by trusts in that same time frame. The account return to the SFA by mid-Jan 22. Don't know at the point of recording this session exactly what that date will be, but mid-Jan 22. Accounts on the website by 31 Jan 22. And then given that academies, of course, are limited companies, they would need to file at Companies House by 31st of May of 22. And if you're regulars on Academy updates, you'll be familiar with that sort of idea of the time frame for the various reporting aspects. Back to normal, we think, for this year's assignments. Okay, I've got 4 practical issues. The first of which is income recognition. And yeah, it's the issue of grant income. And I think in the context of academies, as with charities generally, always important to remember that whilst under FRS 102 generally, we've got 2 options in terms of accounting for income, the performance model and the accrual model. What the charity SORP says is you can't use the accrual model. You've got to use the performance model, which basically means that you will bring grant income into your P&L, you'll bring grant income into your SOFA when you meet the relevant criteria of entitlement, probability of the monies crystallizing, and measurability. And whether it's charities generally or academy specifically, it does always, I think, leave people feeling that income's being brought in earlier than you might think it ought to be. I think when it comes to academy audits, I think the true and fair audit of an academy is a reasonably straightforward exercise. I think auditing income is generally reasonably straightforward from a true and fair point of view. Where I think we can get, a few issues will tend to be around grant income cutoff, particularly for capital projects. And I think if people grasp the way the accounting rules work, that then does make the audit become significantly more straightforward. Okay, let's look at some practical scenarios. Here's the first one. And the school is currently being extended to increase accommodation. The local authority has funded 250k and has provided a letter of support, a letter of comfort for the other 250k. How much income should be recognised? Well, the first 250k one would imagine will be pretty straightforward. That's going to be brought in. It's already been provided. So debit bank and credit SOFA. The other 250k, you've got to look at that at the year end and say, right, well, how confident are we that money will actually be coming in the door? And look at probability, look at entitlement, look at measurability. And if you are confident that money will come in the door, it probably will crystallize, then you'll bring it in and you'll accrue for it in the SOFA and into debtors. The thing to ask yourself with these sort of situations is, are there any substantive performance conditions which the trust's got to comply with in order to be eligible? And if there are none, you bring it in, even though clearly there'll not be an expectation to spend the money until the next following year. Can COVID catch-up funding at the year end be treated as deferred income rather than being recognised in full and carried forward in the restricted funds balance? I think the principle here is very similar to the previous example. The sense I've got in terms of COVID catch-up funding is that where you received it in the current year, but not spent it in the current year, you can absolutely roll it forward and spend it in the following year. And therefore, on that basis, I would say it will be current year income and restricted rather than deferred income. Deferred income in a grant context, really, for charities generally and academies specifically, is when you've got a situation whereby you've got to meet a relevant performance criteria in order to qualify. In the context of this situation here, as long as you can roll it forward, you do still have the entitlement, and therefore would very much be a current year income item in the SOFA. The related question, I guess, there also would be, do we have an obligation to repay it if we don't spend it? I think the catch-up funding is based on headcount, and if therefore you based it on an estimated headcount and you got your calculations wrong, there may well be an obligation to repay it, in which case you provide. And if you think you'll probably have to repay it, you would provide. If you think you'll possibly have to repay it, you disclose it as a contingent liability. If you think there's a remote chance of repaying it, you would do nothing at all. So section 21 of FRS 102 on provisions, that interlinks as well here, but fundamentally, don't defer it, recognise it in full and carry it forward in the restricted funds balance would be my suggestion about the way that you tackle that one. Okay, let's move on to computer equipment. And the issue again here, as with the previous example in the last section, is all around, I suppose, some of the COVID implications. And what we're looking at here is where maybe schools have received IT equipment, to dole out to students, to enable them to work, at home during lockdown. What would the accounting look like? If you've got a situation where the school is purchasing equipment outright, then I guess the question would be, is that capital or is that revenue? To me, IT equipment feels all day long much more like capital spend and much less like revenue spend. It may well be that some organisations have got a de minimis beneath which they actually expense costs come what may, whatever they are in terms of their nature. But one would imagine if you have schools buying this kit outright, that will be capital asset on the balance sheet and not revenue expenditure in the P&L. What I've had a sense of in recent weeks, though, has been that more often when it comes to schools sourcing this equipment, it's more likely to be on a lease than buying it outright. And of course, if it's bought on a finance lease, that will be on the balance sheet. If that were an operating lease, it wouldn't. The other complication, I guess, with academies would always be that if you're actually going to borrow money, you need to get prior ESFA approval to justify that borrowing. Finance leases, of course, are borrowing in substance and therefore would need prior ESFA approval. So very important to make sure that from a trust point of view, you are looking at the minutiae of the agreement there, timely and in the moment. And if you conclude finance not operating, you do get that prior ESFA approval. Otherwise, that's a breach of regularity that could give rise to the reporting accountant modifying their opinion on regularity. So yes, talk to your auditor in the moment with those transactions. The accounting that can be sorted later as far as the financial statements are concerned. It might be in some situations that schools are quite simply a conduit to get kit from providers direct to students. And in that case, I guess it'll be an agency transaction where it wouldn't really wash through the school's books at all. I'm also aware of another situation where it might possibly be that IT equipment is being donated to trusts. Remember that if per charity SORP you receive donated goods and services, they would need to be valued at fair value. And there could also be practical issues there around valuing that donated equipment if that were the situation the trust were looking at. One more point on the operating lease situation I was made aware of on a course last week. I'm reliably informed that when trusts lease equipment under operating leases of this nature, the deal might be with the lessor that the equipment will need to come back at the end of that lease term for return to the lessor entity. And if that return did not happen, the trust then will be liable for some sort of penalty payments. We'll again go back to provisioning principles. If we think we'll be liable to a penalty payment because we've not kept track of who's got the equipment, we might be able to get it back, then we would need to provide for that obligation if it was probably going to crystallize. If we thought it was possibly going to crystallize, we'd have a contingent liability note, and remote chance, we'd do nothing. So again, another related issue there around provisioning in relation to that lease scenario. And there we are, there's the finance lease definition. You might remember back in the day under the old UK GAAP rules, it's SAP 21, we had that wonderful thing called the 90% test to work out whether a lease was finance or operating in nature. and whether risk and rewards were transferred to the lessee. That, of course, dropped out when FRS 102 came in back in 2015. And we now have to think about whether, on inception, the present value of the minimum lease payment amounts to at least substantially all of the fair value of the leased asset. That might be a moot point, which is why I think getting input from the audit firm timely in the moment is always helpful to make sure academies do the right thing and do not then breach regularity in the way that I've described. Okay, third issue for August 21 year ends is pension scheme liabilities. And the question we get asked all the time is what's going to happen to those liabilities for 31st of August 21 year ends. The expectation, I think, is liabilities will increase on the balance sheet. Remember that the LGPS liability, being a defined benefit scheme liability, is the net of the fair value of scheme assets and the net present value of scheme liabilities. And that net present value is derived by taking future pension payments to the scheme members and discounting them back to net present value using a yield on a high quality corporate bond. Because bond yields are low, that NPV figure is high, and that will therefore mean for 31st of August 21 year ends that the net liability is high also. I've also made reference on this slide to High Court rules on GMP equalisation of transfers. Again, this is a legal case that affects LGPS liabilities. You may remember it goes back 3 or 4 years now, whereby certain defined benefit pension schemes offering guaranteed minimum payments were judged over the years to have prejudiced female members, whereby adequate provision was not made for them. And the High Court ruling back in 2018 said there was going to therefore be a need for a top-up to make good. And that again, in turn, increased liabilities in that situation. The ruling in November of last year has been to do with transfers, i.e. scheme members as of 1990 that subsequently transferred their contributions out, and were they eligible for top-up as well? The High Court ruled yes. That therefore means more obligation. It's all going to put pressure on liabilities. Now, whether that will actually impact for 31st of August year ends, I think is debatable, but it will ultimately impact. It all puts pressure on liabilities and all weakens fundamentally the balance sheet of the trust. One other point to mention in terms of LGPS liabilities from an audit point of view, do remember that's an accounting estimate, and you do need to, what I would call, therefore, kick the tires on the assumptions that underpin that estimate, both the assumptions that underpin the liability portion and the assumptions that underpin the fair value of scheme assets portion. I would say that of all the things we raise on academy audits, lack of scrutiny of the assumptions that underpin this net liability is by far the most common, and that's why I wanted to mention that here today as well. Okay, and issue number 4 is review and oversight. Yeah, and again, you may have seen in the press the recent case of ABE, Associated British Engineering. This was a listed company audited by a challenger firm, and a really interesting case for those of us that get involved in slightly smaller audits. This company turned over 1 million, and the issues raised by the FRC in their review were very close to home, I think, for many of us in terms of the sort of things that we do see going wrong on audit files day to day, including, as you'll see there, lack of scrutiny around the assumptions underpinning the defined benefit pension scheme liability. But what I wanted to raise with you, though, was the point about review and supervision. And again, this has been a recurring theme on a lot of the FRC investigations in recent years. The audit RI spent no more than 5.5 hours on the review of the job. And although the numbers were small, it was a listed company and therefore very much a high profile audit, of which 40% of the time was spent in meetings with the clients. So what the FRC are looking for there is for the partner, I suppose, the RI, to really roll their sleeves up and get stuck in a way that they didn't. And increasingly, when we do see these FRC investigations being explained in their pieces, their articles, they do also increasingly challenge and provide hard feedback for the audit manager as well. And the audit manager in this case, I think, had spent time on the review weeks after the fieldwork had been completed. And some of the working papers that he or she had signed off as being reviewed were working papers that they themselves had actually produced. And why I think that's very relevant in an academy context, I do think it's a very compressed auditing season for academies. Of course, you've got your true and fair audit, you've got your regularity review. I think RIs and managers are very time poor in what is a very, very busy season. But to make the point, the FRC, the ICAW, the ACCA are very keen to get evidence of the partner's report on the file from a review point of view. So don't forget that even though you're really busy over the next few months, evidence review is really key. And that, again, is also a very important imperative as far as these audits are concerned. Okay, so that's my 4 key areas to focus on as far as the 31st of August 21 year-end reporting season is concerned for academies. Wrapping up then, normal timetable resumes. Do look out for a supplementary bulletin, which the ESFA are going to publish, I think, in the next few weeks, all around some of the actual specific issues around COVID and how they would inform financial statements, audits, regularity reviews. There is a similar bulletin for 31st of August 20 year ends. The expectation is for a similar bulletin in the weeks to come, relevant to 31st of August 21 year ends as well. Income recognition follows charity SORP, and for a lot of people is a bit counterintuitive. I think a lot of us lean towards the accrual model when it comes to income recognition, but the charity SORP does not allow that. And therefore, I think income cut-off in charities, income cut-off in academies can be sticky. But if you've got a good handle on the way the accounting rules work, the audit then should follow on quite easily from there. LGPS liability is often an area of concern for file reviews. I explained why. It's also a figure that will increase, we think, for 31st of August 21 year ends for the reasons I mentioned, and keep a handle on review. Very topical to make sure that you do keep a handle on review, despite the fact that in this next few months, firms are very busy when they've got lots of academies, audits and regularity reviews to get finalised and away. Okay, I hope that was useful. Do drop me a note at inquiries@insight-training if you've got any questions off the back of this short session, and do check out our website for more details of our full programme of CPD events running throughout the autumn. Have a good summer, and I'll see you there. Thank you.